Okay, ladies and gentlemen, welcome to this third session at the AMA Financial Reporter Theatre. I'm delighted now to introduce somebody from the Financial Conduct Authority, our conduct regulator. Having implemented the Mortgage Market Review, running alongside that for most of the last 7 years, we've been negotiating in Europe what eventually became the Mortgage Credit Directive, which is due to be implemented next year. There were probably 3 people fundamental in how that shaped from a UK perspective, and a couple of people at the Treasury and 1 person at the FCA, that person being Keith, who is a mortgage technical specialist at the FCA. And we, as a trade body, have worked closely with both Treasury, who are fundamentally involved in anything that happens in an EU regulatory basis, and the FCA as the product specialists, in trying to ensure that this fits as best it can within a UK framework. That, of course, is constrained by the fact there are a number of other countries who are also trying to make this work, and therefore what you end up with is a horse that ends up a bit like a camel. And that is the problem that we have. Now, whilst the FCA did the best they could to make sure that we future-proofed through MMR what the directive demanded, there are certain technical aspects that came about in the directive that means we still have to make further change. Not all of that will probably benefit the consumer, but it's bureaucratic change, administrative change, and technical change that we have to do in order to comply with the directive. And what's been pleasing from our perspective is that both Treasury and the FCA have been trying to work with us as an industry in order to try to minimise the impact of that and try to interpret it in the way that's almost as liberal as we can get it. So whilst there's some stuff that appears a bit strange and difficult, it's not through a will or lack of desire from the regulators to get it in the best place possible. And I've been very grateful for the work we've done with Keith over the last couple of years to get there. So I would ask you please to show due respect to somebody who has worked very hard on behalf of the industry's behalf and having the bravery to come and field himself in front of such an excitable bunch as you lot. So please welcome Keith Hale to talk about the Mortgage Directive. Keith.
Good afternoon, everyone. Thank you very much indeed, Robert, for the invitation. Thank you for filling the seats in such great numbers. I'm very pleased to be in front of you today to explain the camel that we've been left with in terms of the shape of regulation, which we will all have to deal with post 21st of March next year. I'm also grateful to Robert for this invitation because this is the second time I've been to Manchester in the last 5 days. And on Friday it was sunny and it was warm. And so today I've got a chance to see the real Manchester. Right. What do I want to talk about? Right. So 3 things really I need to cover and dealing with those in turn, our high-level approach to the regulatory changes, high-level approach to the directive. I'm also going to talk a little bit about second charge regulation because the two are intrinsically linked for us and for you because the directive doesn't distinguish in any way between first or second charge lending. So that is the reason why second charge is going to be regulated as a mortgage as of next March. So I'll talk to you about our high-level approach on both those topics, a little bit more detail about the key changes in the regulation, and then really what I want to focus on is what we think they might mean for you, what are the questions which we think you ought to be engaging with now, where do we see the challenges, what do we think you might want to do in terms of some of the novel requirements of the directive. Right, our high-level approach. This is a directive which is trying to introduce across 28 European mortgage markets a level of consumer protection and also to do something to boost the single market, to try and stimulate some cross-border mortgage activity. What it is not trying to be is a one-size-fits-all approach to how regulation should deal with detriment in national mortgage markets. The directive very clearly recognises that national mortgage markets are different and will remain different. So it's trying to do a little in a small number of areas. For some member states, this will be the first consumer protection they have in the mortgage space. Now, for the UK, it is far from being the first. We obviously have an extensive set of national controls around mortgages. So our approach fundamentally is that this directive actually adds little of consumer benefit. We have protections already in place which go well beyond what the directive is trying to achieve. It adds a little pain, though, this directive, because sometimes it tries to achieve the same protections as we've got in the UK, but via different means. So there's a little bit of grit in the system. For us, it's always been about how can we make certain that we do what we legally have to, which is comply with the directive, but to do it in a way which, as much as possible, minimises disruption for the market, minimises the cost impacts for both firms and consumers. Our way of doing that is really to rely upon our existing national rules. Wherever we can, we are going to use those to implement the directive. But there are some areas where the directive introduces a new form of protection, something which we don't have in our rule book. In those areas, again, because we want to do the bare minimum, we are simply copying out the directive requirement. So any flexibility that we've managed to negotiate into the directive, we're passing straight on to you as firms. You will have that flexibility. This is not a case where we are going to be prescriptive and actually tell you how you should go about meeting directive standards in a particular way. If there is flexibility in the directive, we hope you can use that flexibility through us simply copying out the requirements. And the other thing for us, and why I'm here speaking to you today, is that we heard very clearly from the industry that the directive was going to take time in order to transpose and implement within firms. So we, from the very outset, we said we want to give people 12 months to implement. So we've worked through making our rules very quickly. We consulted last autumn. We produced our final rules in March. That means you have 12 months in which to prepare for implementation. That means we are ahead of the game in terms of Europe. No one else has made their rules yet. So if you start asking me questions about what does this mean for doing business in Spain or doing business in Greece, I'm afraid I can't tell you the answers yet. I can tell you what the directive says the answer should be, but those other member states haven't yet actually introduced their implementing legislation. Because I'm not necessarily going to focus on second charge too much as I go through the MCD requirements themselves, I just want to pause for a moment and think about and make certain we're all on the same page in terms of the changes which are happening on second charge. As I said, the reason for second charge becoming a regulated mortgage contract in the future is simply that the Mortgage Credit Directive doesn't distinguish in any way between loans secured by a first charge or a second or a third. So that's the rationale why second charges, which are currently regulated as a consumer credit loan, won't in future be regulated in that way and will be regulated as a mortgage. That addresses one of the issues with the second charge market, which is that fundamentally it's been a market until now which has been shaped by regulation. Ever since the decision was taken by government to make the FSA, as it was then, the regulator of first charge loans, but to keep second charge in consumer credit, what you've seen is a market which has diverged because of the different regulatory regimes that apply. But actually, the consumer risks are the same here. Ultimately, the consumer faces the risk of, on default, of losing their home. And the product is essentially the same. A loan that is secured on the residential home, it's not that different, whether or not it's a first charge or a third charge. Fundamentally, the product is very similar, but is evolved in slightly different ways because the regulation is actually different. And I want to touch on that point on a later slide. So product is the same, fundamentally. The risks are the same. What we do see with the second charge market, unarguably, is that there is a higher level of detriment. And I think the best way of looking at that is the higher level of arrears figures and also the speed with which loans go into arrears. And we provided quite a detailed breakdown of that in our initial consultation at the end of last year. So in terms of crystallised detriment, we could see particular risks in the second charge market. And finally, I guess, firms who are active in both markets were making the case for there being a similar regulatory approach. Please, can I have just one system for dealing with all these loans rather than necessarily needing two separate ones? So where did that take us after consultation? Well, that took us to a place where the MCD is obviously going to apply to second charge because it has to, but fundamentally we are regulating second charge loans in exactly the same way as our rules have applied in the past to first charge. So the MCOB conduct regime, the requirement for advice, the responsible lending obligations, those will all apply to second charge lending going forward. We've also needed to think about some additional measures. Best example of this is the stress test, which lenders will have to employ, because it makes sense, we think, and consultees agreed, that actually, if you're stress testing the loan, you need to be thinking about the stress also for the first charge loan that the customer has. You need a way of actually accommodating the impact of interest rate rises for both of those secured loans. Similarly, there's one or two bits of protection which we think it's important to carry over from the second charge regime which currently applies. And the most obvious of those is in relation to interest on default charges, where currently that should be simple interest only, and we think that's an important protection to maintain. But as we make these changes, as we bring second charge into our first charge regulation, it's also important to think about what will no longer be there in terms of the Consumer Credit Act controls and the controls which have shaped the second charge market until now. So if you are in a second charge market, you'll be used to giving out advance copy agreements on behalf of the lender. That won't be an obligation any longer. You will be used in the second charge market to having a particular fee structure dictated to you because the Consumer Credit Act actually denies you the opportunity to keep a fee if the loan doesn't complete. You can only keep a £5 fee. So that's changed the charging structures in the second charge market. That will go away. We will be allowing firms to make upfront charges where they reflect the work that they do, where their customers are willing to pay those charges. So we expect to see market evolution there in terms of firms charging upfront for their services. After you've provided your copy agreements, there is under the Consumer Credit Act a no contact period. So there's a reflection period where you shouldn't have contact with the customer. That won't be part of our regime going forward. There's a modifying agreement regime under the Consumer Credit Act which actually constrains the way in which lenders can deal with their existing customers and the variations that they can offer them. That will be going under our regime. There won't any longer be restrictions on early repayment charges in terms of capping the amount that the lender can charge. So we're hopeful that the way in which we are going to be regulating the second charge market will actually remove some of the constraints that are on the market at the moment, where maybe we will see a slightly more innovative market, where we won't just see plain vanilla variable rate loans. We might see a range of products developing, fixed rate loans, or alternative options there for customers, a market which maybe is more obviously substitutable for a first charge loan in certain circumstances. And that substitutability is something I want to talk about in a moment. So let's think about the changes which are coming down the road. And there are 6 key changes which are bulleted on the slide there, which I'm going to talk about in a little more detail in a moment. These are changes which hopefully are relevant to a great number of you, certainly things on 3 or 4 of those where I want to prompt you to start thinking now about how the new regulation post 21st of March next year will have an impact on your proposition. Worth touching, though, on just one or two other points in the MCD, which you might want to reflect on. So before launching into this list, just to be aware on remuneration, where you're giving advice, the MCD has a new standard, which is about remuneration policies not being contingent on a given number of loans being sold or a particular type of loans being sold. Now, I don't know how you currently provide for your remuneration for staff, but what we're talking about here is the directive frowning upon sales targets, not frowning upon remuneration for a sale, but saying you shouldn't have a remuneration policy which actually rewards a customer rewards an advisor for selling 10 of a particular loan. You can have a remuneration per loan, but if there's a particular target which the advisor has to meet, then that is frowned upon under the regulation. There's a ban on tying in of products with the mortgage. There are some exemptions to that which relate to particular UK market scenarios, things like the lender hand products, which require the customer's parents or another family member to bank and have funds accessible to the lender. But otherwise, there is a ban on the tying in of products. So if you are thinking about bundled propositions, propositions with tied insurance, those are going to be prohibited going forward. And finally, if asked to think about an upside of the directive, and sometimes that's a little difficult, one of the upsides to the directive is that there's a passport for mortgage credit intermediaries in future. So actually, if you see a market, if you see a customer demand for you actually being doing business in other EEA member states, you will no longer need to be authorised in those other countries. Once you are authorised with the FCA, then you can take that authorisation and passport into a second or a third or a 27th other EU member state. Conversely, intermediaries in other member states will be able to passport into the UK as well. And you may ask me the question, who's going to be doing that? And frankly, the answer is we do not know. Until the regime goes live, no intermediary has to indicate their intention to passport. It may be that there are very few firms from outside of the UK which want to enter into this market. It could be that we receive a notification from hundreds or more. We will have to see, and the challenge, I guess, for the industry and particularly for lenders would be if there are new intermediaries passporting in, how do they get themselves familiar with those new intermediaries? Okay, so some of the particular challenges which come with the MCD. Firstly, permissions. So the regulated activities here are changing. So for second charge business, you will no longer need a consumer credit permission after 21st of March next year. If you have a mortgage permission, you're already covered. If you don't have a mortgage permission, that is the permission you will need for second charge business. There will be no distinction in the permission between whether or not you're doing first or second charge business. It's simply a permission to do an activity in relation to loans that are secured on land. There is a new permission which I'm guessing very few of you will need, but maybe you'll tell me otherwise. There's a very small category of lending which the directive captures, which we have never traditionally thought of as being a mortgage. And this is lending which is not secured on land, but which is used to acquire or retain residential property. Examples I've been given in the past has been something like a farmer who actually secures the loan for his farmhouse, he secures on his outbuildings or his agricultural machinery. Probably very limited examples of this, but it's not covered by the mortgage permission. If you are giving advice on those sorts of transactions, there is a new regulated activity. So if you think you're ever going to be in that market, that's a new permission which you will need to apply for. As ever, there are specific pages on the website which are designed to help people who are thinking about either applications for the first time or or applying for new permissions in addition to their existing permissions. So that's the resource to use, other than going to talk to my colleagues who are outside today. The key point is that you will need that permission as of 21st of March next year if you're to carry on doing second charge business. You won't be able any longer to do it under a consumer credit permission. Advertising. Advertising, the directive in a way is quite liberalising because it provides an opportunity for us to simplify our current controls. The directive, if you talk about interest rates, if you talk about any financial information really, which relates to the cost of credit, your advertisement has to give a full representative example. The small print of which you'll be very familiar with from credit card advertising and the like. So you would have to give that schedule of the full loan amount, the number of payments which are expected, detailing the individual fees which apply to the loan and the overall cost of the loan. But if you don't give that financial information in the advert, if you talk about the service you provide, the proposition that you offer, you don't have to give that representative example. And this is where we've been liberalising, where the rules have allowed us to simplify. We're actually going further and we're saying you no longer actually need to give the risk statement. You no longer have to state the fees that you charge for advising or arranging a loan. Instead, we're saying if you're doing that very general advertising about your brand, your proposition, your service, please, fair, clear, not misleading. Otherwise, it's up to you. You can generate the form of advertising that best serves your needs. Where we think this is going to be really helpful for firms are things like social media. If you've ever tried to do a mortgage advert on Twitter, 140 odd characters, that's your risk warning. You can't do anything else. So hopefully it's a liberalising measure in that sense. It will allow you to think about other ways of engaging with your customers, providing, as I say, that you don't go into financial information, mention cost information. If you do that, then there is this need for a full representative example. Right. The service you provide and how you describe that service. Here, the directive and the change that comes with our regulating the second charge market as well, this is where the challenges, I think, are really going to start for you in terms of day-to-day thinking about your proposition. In a way, the directive is very similar to our existing approach. We obviously formulated our MMR rules knowing where the directive was going. So the focus of the disclosure is still about scope and remuneration. There's a bit of grit, which is the directive introduces, because that disclosure has to be in a durable medium. Now, currently, if you're interacting with the consumer, if it's a face-to-face conversation that you're having, then we require that to be an oral disclosure. The directive is saying it also needs to be in a durable medium. So one of the things for you to think about is, what if you're having that contact with the customer on a telephone? How do you get that disclosure to the customer in a durable medium? And here, just playing back to you some of the things which we've seen firms doing, capturing an email address so you can email the customer your service disclosure is one way of approaching that particular challenge. More fundamentally, you've got to think about what is your scope of service in this new world with the FCA regulating first and second charge loans in the same way. As far as our rule book is concerned, we have a market now which is a single market of secured lending. That's not saying that you have to offer that single market, but you need to have a clearly described proposition for your customers about the market that you are engaging in. And one of the drivers for that is going to be the disclosure obligation which you're going to have to give. If a customer with a mortgage comes to you, you're going to have to not only talk about their options in terms of either a first charge mortgage or remortgage or a further advance, which is a current MCOB requirement. Going beyond that, you're also going to have to notify the customer that they may have substitutable alternatives, which are a second charge loan or potentially even an unsecured loan. So you're going to have to tell your customer about those alternatives. And we think that also means you're going to have to engage and think about how many of those alternatives do you actually want to offer to your customers? Are you going to be comfortable saying, second charge lending is an alternative, but I don't offer that? Or do you want your proposition to be, instead of a first charge remortgage, there's a second charge loan might be the right answer for you, but I can't help you. So how do you want to describe your service going forward in this world where, in a regulatory sense, there is a market, a single market of secured lending? Once you've worked out what your proposition is, then the challenge is, how do you convey that to the customer? How do you pithily get across the service that you provide? If the service you actually provide is that you focus upon the first charge market, but you can introduce the customer to someone else should they actually need a second charge loan, then that's got to be your description. You can't tell the customer that you offer a service across all the first and second charge market if actually that's not what you are doing. You are just introducing the customer to a second charge specialist. So it's opportunity ahead of 21st of March next year for you to think about where you want to position yourself in the market going forward. If you use the label independent, some people highly value that as a description. Currently, obviously, with the first charge market, if you have unlimited access, which can include getting that unlimited market access through a panel, if you have that unlimited access, you're going to have to think about how you get that same access for the second charge market if you want to carry on describing your service as being independent. So it's really about, think about your proposition, say to your customer what it is that you do, and then do what you say. I feel a bit Roy Walker and catchphrase-ish when I say that, but it really is about say what you do what you say. One final little bit of grit the directive introduces on service disclosure. You're going to have to tell the customer that they can ask you for information on the levels of commission that you could obtain from across the market. Now, the idea behind this is that the customer would get this information off of you and could see that you were getting, 0.35 from the particular lender that you were recommending, but that there were other lenders on the market who were only offering 0.25% commission. And the consumer could form some sort of judgment. Frankly, I don't know what sort of judgment the consumer would actually form on the basis of this information. But it's there, it's in the directive. You are now going to be obliged to tell the consumer that they can ask you for this information. So what you need to be in a position is to be able to give them this piece of paper, which tells them the different rates of commission which you can access across the market. Now, that's something which the market is going to have to work on in terms of giving you as individuals an easy answer, an easy way of providing this bit of information. So networks, mortgage clubs, third parties, here's an opportunity for you to do something for individual firms to develop a standard form of information which brokers can provide should a consumer happen to ask them for this information. Product disclosure will be changing. The good old KFI will be changing. It'll be changing soon if we're talking about a second charge loan. Second charge loans, as of the introduction of the MCD, they will have to give out this new disclosure document, this European standardised information sheet instead. If you want to see what that looks like, we put together a number of mock-up examples which you'll find at the back of our policy statement. So second charge firms, they will have to use this as of next March. First charge firms is slightly different. There's a transitional window in the directive which actually allows first charge firms to manage the delivery of the ESIS and to keep using the KFI for a certain period, for an additional 3 years, providing that KFI is equivalent to the ESIS. So in the first charge market, there's this choice for lenders between going with the ESIS document or keeping the KFI for an extra 3 years, but supplementing it with some additional information. And what that means for you as intermediaries is that you are going to be dealing with 2 different forms of disclosure. Definitely for second charge market, you'll be giving out an ESIS. But in the first charge market, you may have 2 quite different looking forms of documentation, which you'll be having to get yourself familiar with and having to explain to your customers. And you will have a moving set of goalposts in that lenders will be choosing at some point between 2016 and 2019 to make their changeover from the KFI to the ESIS. So you will have a 3-year period of flux, and consumers will have that 3-year period of flux. It's not a great place. What it does mean, though, is that we and you are able to more smoothly manage the costs of introducing this new disclosure and therefore avoid passing on to consumers the costs of everyone having to meet the ESIS disclosure as of next March. And frankly, as we know from the MMR research, the disclosure is used more by consumers as a record of their transaction rather than as a tool for the purchasing decision. Consumers are much more receptive to the information they get from you, from the information they get from friends, family, rather than the paper disclosure documents. So it's going to be a period where there is a degree of difference in the way in which disclosure looks, and the market is going to need to accommodate that difference, work with those differences. One of the differences which is going to be there in the future for you, whether or not it's in the ESIS or whether or not it's in a KFI with the topped-up information, is that you are now going to see a second APRC in the disclosures. And you're going to have to think about how you explain that second APRC to customers, because it's going to be an APRC which has the intention to shock, or at least which has the intention to put consumers on notice. It's an APRC which is intended to show how interest rates can vary. So it's intended to reflect a 20-year high of variable interest rates. So how are you going to explain that to your customers? How are you going to draw their attention in a balanced way to the different bits of cost information which the disclosure is going to be presenting? And that's key because as part of the directive, there is a new obligation that for every sale, there should be an adequate explanation given to consumers. So it's not about just giving the consumers your service disclosure document and your product disclosure document. You've actually got to explain both of those, and you've got to explain what the key characteristics are of the product, So if it's an offset mortgage, what are the key features of that mortgage? If it's a fixed, how long is it fixed for? What happens at the end of that fix? You've got to explain the effects of taking out the loan. Now, there's a very broad term. The directive seems to be focused upon what is the downside risk. So I think it's an explanation of the consequences of defaulting on the loan. And you've also got to explain that if the consumer is choosing to take up ancillary services with the loan, can they cancel them separately? And what are the consequences of separately cancelling them? So if they're taking out an optional insurance alongside the loan, then can they cancel that without any impact upon the loan itself? Now, we've approached this through our consultation by saying we think these are things which advisors will be doing in the course of their day-to-day job of providing advice. And pleasingly, people who responded to our consultation, they said, yes, absolutely, these are things we are already doing. So hopefully there are no new burdens in here. But I would stress it's worth checking, just making certain that those are the points which you cover as you go through an advised sale. Conscious of time, so moving on quickly, binding offer. There's a new obligation for lenders to introduce a binding offer which they are clearly going to stand behind. And obviously, lenders do that already, but they maybe do it in a slightly unformalised way, having first of all provided decisions in principle, approval in principle. Lenders are going to need to think about an offer process whereby it is an offer which doesn't give them the opportunity to re-underwrite. It may be an offer which includes conditions, and those conditions have got to be justifiable conditions. They may be conditions which work to the benefit of the consumer as much as the lender. So if there has been a change in the consumer's circumstances after the offer has been made, such that they've been made redundant, or maybe the property is burnt down, those are conditions which clearly reflect that it wouldn't be in the consumer's or the lender's interest for the loan to actually proceed, for the offer to be binding. So there's a process for lenders to go through to look at their existing offers and make certain that the conditions which are in them are justifiable conditions and are not conditions which just give them power to re-underwrite the loan post the formal offer being made. The binding offer is important because it's the trigger period it's the trigger point rather for a right of reflection. A new right of reflection consumers are going to have 7 days in which they can take the mortgage offer, go away and think about it. Or they may choose not to. They can waive this reflection period immediately. And I imagine most consumers will do that. Most consumers are actually just interested in getting access to the money. Question for you, question for lenders is, how are you going to capture that consumer decision? If they have this right of reflection but choose to waive it, somewhere that needs to be recorded if the consumer is waiving that right. Are lenders going to be looking to you to actually capture that decision? So there may be some changes in process to ensure that this right of reflection and the consumer's decision whether or not to exercise that right, how that's captured so that you can later demonstrate it. A real thorny issue, nice one to end on in terms of the directive, is that there is no transition built in for sales that are underway on the date that the mortgage comes into force. Maybe it was thought somewhere that mortgage sales begin and end in one day. Quite clearly they do not. Mortgage sales take a period of time. We know that, you know that. Unfortunately, the directive does not recognise that. The directive assumes that if there isn't a credit agreement in place on 21st of March next year, then all of the directive requirements will apply. So what we want to avoid, and what we've been working with the industry and with government to try and manage, is that sales which are already underway before 21st of March, that those don't have to be restarted from the beginning and the consumer has to go through a whole new sale. Now, the way in which we can deal with that is that we are turning on our rules early. So as of 21st of September this year, if you are ready to go live with the MCD rules, then you can meet those rules, and that means you can start off a sale safe in the knowledge that if that sale hasn't completed by 21st of March next year, you're already compliant. You've already done everything you need to do. So our rules allow you to be ready for the pipeline. Trouble is, are you going to be ready? To take advantage of that needs you to work even quicker, to have worked through your systems to be ready to comply ahead of 21st of March in order to take advantage of that. And that means you individually, and that means the market as a whole. So lenders will be thinking about, when do I want to begin complying early in order for me to ensure that my pipeline is covered? But if the lender wants to go early, they need their distributors to be ready to go early. And so there's a real need here for the market to be talking, for lenders and intermediaries to be having that dialogue, to be working out when people are expecting to switch over to MCD compliance, so that firms who are ready to go have a distribution chain which is also ready to go, because that's the only way in which it's going to work. That's me. If I was talking to a group of lenders, I'd have talked about a different set of challenges in terms of the precise form of the product disclosure, in terms of binding offer, in terms of the creditworthiness assessment. So the thing to bear in mind is that the MCD is impacting on the whole market, but it has rather different sets of challenges for intermediaries as opposed to lenders. But a number of them you're only going to successfully address if there is an industry dialogue. And I know that's a point that Robert on other platforms has already made. And it's something certainly that we would be encouraged to see in terms of the industry, lenders and their distribution partners actually having a shared sense of how the changes are going to be introduced. And a shared sense which also reflects our desire to see this change happen in a way which is as non-disruptive, avoids introducing unnecessary burdens. Because, when we go back to my message from the beginning, this is something we have to do. This is something where we're delivering on our obligations under European law. It's not something where we see particular consumer protection benefit. So we are looking to approach this in a pragmatic way, and we're equally looking for the market to do so.